using these formulas. Now, here we have a bigger topic, and that is under which scenario we are not going to use the DCF in the evaluation process. Okay, especially for high tech and biotech or pharmaceutical companies. Many of them, they rarely pay dividends because of their cash flow structure, right? They just need to, save their cash flow generated by their daily operations for future business. And that's how it works. So in that case, we need to use, some financial ratios. We call it financial multiples, which is very commonly adopted in the industry because this approach is fairly easy and fairly, low cost to implement. Okay, so let's just be clear about a couple of things. What is PE ratio? PE ratio is the price per share divided by EPS, and the EPS is the ratio of net income over shares outstanding. Okay, so obviously it captures the dollar return to the investors on the per share basis. Okay. I believe you have seen this thing before, which is a very important financial healthiness measurement. Okay, but well, one caveat is we cannot, just blindly pursue the PE ratio because, if the PE is too high, that might be a problem associated with this kind of a representation, right? Just look at the denominator, EPS. Well, a high PE ratio could be driven by a high price per share or an extremely low EPS, right? So we really need to, get a big picture as opposed to simply focusing ourselves on one single measurement. Well, having said that, this is still an important measurement because it's meaningful for our computation, okay? So let's take a look. We can find out a benchmark PE ratio, and we can also easily get the EPS of our current company or of our company we are looking at. So what is EPS? Again, it's going to be the ratio of net income over number of shares outstanding. So basically how many shares there are on the market. Okay, so basically this EPS, this measurement is not very hard to find. You just need to go back to the accounting statement, extract the EPS at T0. Now, how to find the benchmark PE? Well, because the PE ratio, you can see the PE is price per share divided by EPS, and EPS times PE ratio, that gives you the price per share, right? So as long as we can find out a benchmark PE ratio, we can establish the stock price without assuming the dividend payout, right? This is a fantastic approach, and we call that a market valuation. So benchmark PE ratio, you can go back to the historical accounting statements, pull out the historical accounting data, and do the historical average, call that benchmark PE ratio. Or alternatively, you can find some sort of a comparable companies within the same industry, similar firm size, market cap, and do the weighted average or whatever weighting scheme. Calculate the average P ratio of your peer firms. And you apply that to this calculation, you can get a price per share at T0. Okay, and you can also establish the lead-lag relationship and just calculate the stock price next period. To do that, you have to establish the EPS over the next period by applying the growth rate. Right, so the current EPS times 1 plus the growth rate, that gives you the EPS next period. And you do that for the benchmark P ratio, you actually can get the price next period. So it's actually forward looking, right? So where does this G come from? Well, it's going to be something over here, right? It's going to be the product of clawback ratio and the ROE. Again, go back to your accounting statement, find out ROE and the dividend payout policy, and so that you can establish the growth rate, and you can apply that to the EPS calculation and correspondingly get the stock price. Okay. It's actually very easy, right? You only have a couple of equations over here so that you can establish the stock price. Okay, so on your textbook, it brings up another sort of interpretation of the PE ratio. Okay, you can think of the price of the security to be a summation of two things. One is the non-growth value per share of the company. Okay, so basically you can think of this company to be enterprise without any dividend payout. So it's just nothing more than a constant cash flows lasting forever. So it's in the form of a perpetuity. So it's going to be earnings divided by R that gives you the asset in place. And the other form of the value is going to be the present value of the potential future investment ideas. We call it the present value of growth opportunity, PVGO. Okay, so asset in place and the growth opportunity. Okay, so your textbook rearranged the formula into this format. Okay, so PE ratio is equivalent to 1 over R times 1 plus the present value of growth opportunity over the asset in place. Okay, it's actually very easy to interpret. Okay, so think about the case where PVGO growth opportunity doesn't exist. What happened? Well, so this term does not exist. And here you have R over E, so that you have, E over R, you will get P0 equal E over R. That is equivalent to the form of a perpetuity, right? That's exactly the idea of asset in place. You don't have any potential for future growth because your future growth opportunity is zero. Now, let's take a look at this. What if PVGO is increasing or is very large? It means that it's going to be a dominant contributor to the price, and the PE ratio itself can rise dramatically. Okay, so that actually entails the fact that the PE ratio is a reflection of a market optimism concerning about future growth prospects. Okay, so let me show you that. Your textbook, I think that's going to be your section 18.4. You can see it has a very detailed discussion regarding the implication of a PE ratio by decompose firm value into present value of growth opportunity and the asset in place. This is exactly identical with the two graphs I draw on the blackboard during class. You can decompose the firm value into these two components, non-growth value component and the growth value component. Okay, there's a variation of the P ratio over here by substituting the dividend into the Gordon dividend growth model. You can see PE ratio can be rearranged into a representation like this. I will leave that for you. It's not very hard. You can think of you can easily get the interpretation of this formula. Okay, I'll leave that as the sort of exercise for you to see if you are comfortable with this representation. Okay, now okay, before I move on to the third analytical framework, I want to kind of mention the advantage and the disadvantage of using the multiples or financial ratios. Okay. One of the major problem is that you want to find out how to say the benchmark P/E ratio or benchmark ratio, right? So it's going to be a challenge to establish the comparable asset. Okay, there are quite significant amount of noise in terms of selecting your peer firms. Okay, so that could be a problem. And the other thing is, I would say sometimes it might be inconsistent with the results of your free cash flow model because you account for different types of a risk. Okay, if you are looking at the discount cash flow model, your major input is your cost of capital, right? So you are really looking at the market risk. Okay, market risk premium is the obviously it's kind of a different from the market valuation approach. You're looking at a PE ratio, which is more firm specific. Okay, and speaking of the advantage of using financial multiples, I would argue the beauty of this thing is that it's easy. You just need to look at the ratios. You don't need to be, you don't want to, confuse yourself by quite a few, advanced models over there. This thing over here is very easy to implement. It's low cost, and you don't need to draw the assumptions of dividend payout. Okay, so this really can generalize the adoption scope of the model. Okay, I think that's the beauty of this thing. Well, I think that's the primary reason why industry people really love using on this approach. Okay, I think the third analytical framework I want to talk about is what we call the alternative discount cash flow model. So the idea is, again, we do not want to assume dividend payout. We want to establish the firm value in the first place and then back out the share price. Okay, so again, to do that, we want to think of a firm value into two components. One is the asset in place, and second is the growth opportunity. Okay, so suppose a company pays out 100% of its earnings as dividends. Okay, in this case, your cash flow will be a constant numbers. That's going to be your E, earnings per share. Okay, if you scale it by the required rate of return, you are going to get your share value. Okay, this subscript CS stands for common stock. Okay, so this is under the 100% payout scenario. Now, how about the PVGO? Let's introduce PVGO into our analysis. Suppose the firm does have some capacity for future growth. Okay, so your share price can be generalized to the summation of asset in place and the growth opportunity. Okay, now think about the establishment of a present value of growth opportunity. Like I mentioned in class, you can think of the value of the company is the value of a series of net present value projects. Okay, you can think of any company to be a function of investment ideas. Each one of them, each one of the idea is going to be an NPV project. Okay, so the PVGO is the summation of the discounted value of all the NPV projects sorted on the timeline. All right. So using the Gordon dividend growth model, and let's just assume a fundamental thing, and that is this NPV level is growing over time. So the PVGO is the discounted value of your NPV projects. All right. Now, how to establish the value of the NPV? Well, you can think of, again, you can use that kind of a perpetuity notion. Your return earning times the ROE is what you are going to invest. Okay. Divided by the R, that gives you the present value net of the initial investment. That's going to be the net present value sourced from your future investment. Okay, and when you do some kind of a mathematical rearrangement, you can sort PVGO into this format. Return earnings multiplied by a factor divided by R minus G. You can see it's very familiar, right? It just looks like a Gordon dividend growth model. And if you rearrange this equation set, it gives you the value of price, common stock price is going to be a function of two things. The asset in place, which is the EPS scaled by R, and plus the growth opportunity. Okay, that's going to be return earning times the factor divided by required rate of return minus the growth rate. Okay, so this portion is growing over time. This portion is constant. Okay, again, you don't need to be responsible for the derivation of this equation, but you want to, be able to, interpret the general notion behind this equation. Okay, there is an kind of a similar alternative approach in terms of the discount cash for the discount cash flow models. The similar idea is that we still do not want to assume the dividend payout. What we are going to do is to calculate the firm free cash flows in the first place. Okay, so the firm free cash flow is the amount of money flow into the company's pocket and is available to pay out to all the investors. Okay, so it's gonna be excuse me, it's gonna be a function of the EBIT, non-cash item depreciation, capital expenditure, and the net working capital adjustment. Okay, so we can establish the firm value in the first place by using by taking the ratio of firm free cash flow and the weighted average cost of capital and the growth rate. Okay, so where does the weighted average cost of capital come from? Well, that's going to be a function of cost of equity and cost of debt. Cost of debt is the yield to maturity, which is the implied rate of return of the bond. And cost of equity is what we been discussed at the beginning of the video. It's going to be a summation of the risk-free rate and the market risk sensitivity times market risk premium. So risk-free component and risky component of the equity. Right? When you take the weighted average of those two things, that gives you the weighted average cost of capital, which is demanded by the outside shareholders. Okay, so that you can get the firm value. When you get the firm value, well, the rest of the job is fairly easy. So firm value minus the debt value, that gives you the equity value, VC, value of the common equity, right? So when you have the value of the common equity, and you scale it by the number of shares outstanding, that gives you the stock price. Magically, without assuming the dividend payout, we establish the stock price. Okay, so these are two important approaches to establish the stock price without assuming dividend payout. Okay. I think, yeah, there are two examples on my slides. I think I went over that in class. Okay, so I think that's all what I have for this video tutorial. Okay, to sum up, we have, let's see, a couple approaches to establish the value of the stock. First is we want to assume firms is paying dividend over time, and dividend could be growing, dividend could be constant growing, dividend could be, randomly growing, or no pattern at all. Okay, you can sort out the cash flow patterns into multiple stages and discount back cash flows stage by stage. Okay, no matter how you want to discount back all the future expected dividend payouts. Where does the dividend come from? Well, you want to draw the information from the income statement and look at their dividend policy and to see how much they are going to preserve for future growth and how much they're going to pay to the investors. We also have the PE ratio approach. We call it financial multiples. If firms do not pay dividend or rarely pay dividend, we can find comparable companies to establish the value of the stock price. But the disadvantage of that is it's going to be a challenge to find ideal set of peer firms or comparables. Okay, that's one kind of a challenge of the implementation of this approach. The third approach is what we call the alternative DCF models. So we sort the firm value into two components, the asset in place and the present value of the growth opportunities. I mean, under this framework, we do not need to look at the dividend payout either. We want to establish the stock price by looking at the firm value in the first place. Likewise, we can use the firm's free cash flows and use the weighted average cost of capital to establish the firm value in the first place as well. Okay, that's the main technicals in this chapter, and I hope this video is going to be helpful. In the second half of the semester, we will talk about another approach to establish the stock value, and that is the contingent claim valuation using options. Okay, I'll see you guys in class.